Welcome to an abbreviated edition of the daily video update. This will cover Tuesday, August 2nd, where we'll look at the action in the market today and then briefly look at how things stand for Wednesday, August 3rd. And not a lot has really changed. We had a down day. Some of the short-term indicators that we're looking at are kind of working themselves off after being pretty extreme positive. We do have a new geopolitical event that has just, it's actually kicked off over the last 24 hours. The Speaker of the House has decided to visit Taiwan. And although the market right now just sees that as political theater, they are not really all that concerned about it. If something were to happen that kicks it up to more of a military action or some kind of an event that leads to going beyond talking and rhetoric and threats and things like that, that could come over into the markets and have an influence. So, but right now that doesn't seem to be really happening, but that could change at any time. Looking at the action on Tuesday, we are still holding up pretty well with a lot of our scenarios. I don't have that many charts to show you, but the ones that I show will hopefully give you an idea that our scenarios are still looking pretty positive. The market is still looking okay overall. We're working off some of the extreme move that we saw last week with our indicators, and things are holding up, at least to this point. So looking at the daily chart, we did gap lower at the open, but I also noticed that the dollar was down. So that gave some support to stocks early on. We came down to S1, tried to drop down a little bit below that, but that didn't last for too long. Came back up to the pivot, which initially acted as resistance. We broke up through the pivot and almost made it back up to R1. Then we saw some selling come back in to take prices back negative, and we drifted sideways and closed pretty much near the low of the session, not at the low, but near the low. So it was a negative day nonetheless. Let's look at some of the other charts here. Here's the daily chart, just showing that we're kind of building up. We've got 3 days now of prices being in roughly the same area, but we did drop a little bit below this pivot level. So that's one thing to be a little aware of. You can see where volume is still well below average and dropped off a little bit. Then looking at the next chart, and I'll have to make this one a little bit bigger, what we're seeing is earnings being revised down overall. And will this continue? This could get in the way of the positive scenarios that we're seeing. Not necessarily right now. This takes some time to develop, but we're seeing that rotation from value back into growth. Well, if the earnings keep getting revised down, that could affect all of the stocks that are having their earnings actually revised down. So we see here, the dark blue line is the earnings revision breadth, and that's trailing off. That means that they're revising things lower. Then we have the 12-month earnings per share forward PE, which has also been declining overall. And this is what the market uses to justify prices going higher or lower, because they're looking out into the future. So we want to keep an eye on this overall. Another thing is the market is still looking at this possible scenario that inflation has topped out and could be coming back down. And we're seeing that reflected in the 10-year treasury yields, where this is what Goldman Sachs is predicting right here, that in 2022, we'll eventually get up to 3.3% with the 10-year treasury. We're down under 2.9% right now. And then we'll kind of drift sideways to 3.15, and then also staying at 3.15 into 2024. Now, this could be wildly changed given the situation, and as things come out that add information about what's happening in the economy. The futures prices are also predicting a slight increase in interest rates going into 2024, but not all that much different than current levels right now. Another chart is just showing the ISM manufacturing index compared to the S&P, where the S&P is turned up, but this gold line here, it's still heading down overall. What could really help things out would be to see the ISM index turn back up when we get the next reading, but that hasn't happened yet. Another thing is the technical score. This is showing how we went extreme negative earlier on, and we're bouncing up out of that as the S&P is showing a little bit of improvement. So we got down to an oversold level down in here, and then we're starting to come back up out of that, which kind of confirms a lot of the charts that I've been talking about in the previous daily video updates. This is also showing the ISM PMI right here for manufacturing, how it has been decreasing, and the ISM PMI for orders has also been decreasing. This is suggesting an economic slowdown and that things are weakening. Now, that could help the inflationary environment, but at the same time, if this ends up going down too much, it could really show more weakness in the economy than the markets may like. Here's our sector rotation. It's still holding up. The Qs outperformed the S&P. We're discretionary. It's pretty much flat on the day, or the large cap growth and large cap value were also flat, but they're still holding up overall. Here's the large, mid, and small caps ratios. Pretty much flat, a little bit higher with the mid caps, and a little bit higher with the small caps also. Where in yesterday's session, we saw the large caps do pretty well and the mid and small caps not do as well. Well, after today's session, we're seeing kind of the opposite. The large caps slowed down a little bit with their rotation, where the mid and small caps ended up holding up pretty well and actually advancing. Here's the intermediate term rainbow chart showing how we went up to the upper side of this and we're coming down slightly for right now. We want to try to get above this and stay above this if we can, to see these other moving averages start to turn back up. Looking at some correlations, we're still seeing a fairly strong inverse correlation between the S&P and the 2-year yield. So if the yield is up, the S&P is likely down. The same thing is true with the 10-year yield. If the yield is up or down, the S&P is now, anyway, going in the opposite direction. The dollar also having an inverse relationship, where the dollar was up in today's session, so that kind of gave some support for the S&P to go down. But if we see dollar weakness, that could give some support for the S&P to advance. Then the tech sector to the 10-year yield, that's also in a pretty strong inverse relationship and has been now for a few days. Looking at our trend, we're just about ready to come back above 20 with the ADX. The green line is on top, even though it's been declining. The red line has been flattening out a bit, but the ADX is above the moving average. So this would then default to a positive trend. I'm keeping an eye on this, the Swinland Trading Oscillator. It was pretty much flat to slightly down based on price, but continues to advance based on volume. This has been doing okay for us lately. Now, there's been other times when this indicator kind of leads us astray. That's why I don't use only one indicator to look at things, because this can change depending on the current market environment. A lot of our other indications that I've been showing with the rate of change, they're working themselves off, except for the rate of change based on 5 periods. It's still pretty extreme positive, and that it could go higher, but it would help things a little bit technically if this was to actually decline. The elder impulse for the SPX is now switched back to neutral. And I haven't showed the stochastics in a while. We're looking pretty extreme positive, but dropping with the short term, intermediate term, rolling over a bit, but extreme positive. And long term, we're extreme positive also, and haven't quite rolled over yet, but maybe starting to do so. We're battling with the 100-period moving average right now. We are going kind of in between. We're in no man's land between the exponential moving average and the simple moving average. It would be a lot more positive if we could stay above the exponential moving average, use that as support, and then eventually break above the simple moving average. And here's our moving average tree, just showing how some of the shorter term moving averages are really starting to turn and go back up. So that's looking more positive. Then the 2-year yield, we're still going with the idea that we're possibly working off of a spike here, but we don't really know that for sure. So we have to keep an eye on that. And that often marks an intermediate to short term bottom in the S&P 500. Then the one that's kind of bigger right now is our staples ratio, which it's continuing to fall. It's off of the low that we saw here, but this is still looking like a valid spike. And again, if you look, that often marked a low in the S&P. After we see some sideways action without things getting really crazy to the downside, once this kind of works its way off, the hope is to then see some more upward movement with the S&P 500. Then bonds were down a little bit, but they're still above this base level that has been forming with the world bond index. And then we saw a bit of an uptick with yields in the treasury arena. So, okay, so that's all of the charts I have to show you for this session or this video. I hope you have a really good day, and I'll look to prepare another video after Wednesday's session.